Good morning and welcome to Stock Market Today. It's Monday, September 23rd, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email to follow along with this show. Get daily stock ideas for you to consider every trading day in your inbox before the market opens. I hope that everybody had a great weekend. Let's get back to it. U.S. equities closed lower in Friday's trading with the blame attributed to the latest comments around trade developments. Healthcare and utilities outperformed while discretionary and technology lagged. Treasuries rallied with the curve steepening. The dollar was stronger versus the euro but weaker against the yen. Gold finished up 60 basis points. WTI crude settled down 20 basis points but still showed solid gains for the week. Now, as we get to the desk this morning, Monday morning trading, S&P futures are a little changed after U.S. equities snapped a 3-week winning streak last week. Asian markets were mostly lower overnight, led by China. European markets are under pressure this morning. Treasuries are rallying across the curve. The dollar is weaker versus the yen, but stronger on the euro cross. Gold is up 70 basis points, and WTI crude is down 70 basis points, reversing some overnight strength. Now, let's take a look at the S&P 500. What I see is some fading from resistance. Now, we've been talking about resistance in the area between 3,000, psychologically important, round numbers, and the July highs up here near 3030. And we are fading from that level. We've been churning in that range right around 3,000 for the past week and a half, 2 weeks. And Friday afternoon, we began to fade from that level. Now, support does come into play, 2,900 to 2,950, and that is a key zone. Should that level give way, we have to start thinking about testing the August lows down here near 2820, which encompasses the rising 200-day moving average. Now, the RSI is beginning to roll over. So should this support zone be tested, what we want to see is the RSI holding in bullish ranges, holding above 40, ideally, really holding above 50 would be really ideal. So we're starting to watch that now. RSI is still in an uptrend, right? We've left the trend line here for you to see. It's still in an uptrend, but just something to start to pay attention to as the market begins to fade a little bit from that resistance zone that we have been highlighting. On the positive side, Chaikin money flow remains bullish, right? So the indicators are still okay. Little price action, some churning around resistance, around that round number of 3,000, watching the support level closely. If the support level gives way, we have to start thinking about down here around 2820. For now, we are staying the course, but we want to give you the roadmap. We want to let you know the key levels that if broken, what the scenario analysis then becomes. Now, our market in a minute, what are we writing about in our note today to Chaikin Analytics clients? S&P 500 breaks that 3-week winning streak last week, and small caps have actually failed from resistance. Remember the prior week, a lot of people were getting excited about some signs of strength in small cap, a little uptick in their relative strength. Well, that pretty much reversed over the course of last week. At the same time, another big reversal was the spike in the 10-year yield that we'd seen the previous week begins to resume its downtrend, and that has led to strength in utilities. Remember, falling rates favor the bond proxy portions of the equity market. Think utilities, think real estate. Futures do point to a flat open today, as we said. Let's take a look at the power bars now. Power bars for the major averages have certainly become mixed. Right, Dow lost 61 basis points on Friday, 3 bulls to 5 bears, continuing to be with a bearish leaning. S&P 500 down 52 basis points, 121 bulls to 85 bears. NASDAQ was an underperformer, and the power bar ratio turned bearish ever so slightly. 21 bullish or very bullish stocks, now 22 bearish or very bearish stocks. Small caps were actually a small outperformer on the day, and their power bar ratio remains bullish. 643 bulls, 294 bears, but the relative strength just is not there for small caps. Can't gain any traction, and we're going to take a look a little bit later here in the show. Bonds saw a good rally, sending yields lower. So according to the Chaikin power bars, small cap stocks and large cap stocks are bullish. Major markets are mixed across the board, right? Because the Dow and the NASDAQ are both bearish from a power bar perspective. Now, our stock of the day is actually one that we wrote about a few weeks ago. CVS Health Corp comes to us from the Food and Drug Retail Wholesale Industry Group, which is a strong group. CVS closed at 64.30, up 1.05% on Friday, so a nice outperformer. CVS has a very bullish shake and power gauge rating due to very attractive financial metrics, very strong earnings performance, and very positive expert activity. Now, the technicals are still mixed as the stock makes the turn here, but when we take the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating. So we have a very bullish stock and a strong trend as it's trading above the rising long-term trend line and in a strong industry group. This is the type of name that we want to consider as a bullish idea. Right. So from there, we take the analysis to see if the market and model are in agreement. And what we see here is a near-term personality change as the rating goes from predominantly neutral to now very bullish, shifting gears back in the August timeframe. Shortly thereafter, the stock begins to outperform the market. So the market and model are in agreement here. Money flow is bullish. Stock is above a rising long-term trend line. The only real issue that I see is from a timing standpoint is that CVS is not quite at an oversold level yet. Now, we had been highlighting CVS back around here, back around the $60 mark when we were very bullish, outperforming bullish money flow, and the stock was oversold. Much better setup than we see now. So ideally, what we would like to see is a consolidation in this $60 to $65 range that produces an oversold reading by our overbought, oversold indicator, and then all else being equal, key caveat, right? All else being equal, meaning it's still bullish or very bullish, it's still in a strong industry group, it's still outperforming the market. Then to me, the setup becomes a lot more interesting on a name like CVS. Throw it on a bullish watch list. I think CVS is a name that you're going to want to revisit in the very near future. Looking at our sector tracker now, the movement of the major sectors over the last 5 days, and you can see that as the week progressed, those bond proxies moved to the top of the list. Real estate and utilities both up 1.37% over the past 5 trading days. That's largely a function of rates resuming their downtrend and also a bit of defensive positioning as the market started to fade from support. Healthcare could also be considered a defensive sector of the market. Now, energy had a strong start to the week, began to fade as crude oil faded. The rest of the sectors were lower over the previous 5 days. Technology, comms, and staples and materials, middle of the road. Now, financials coming under pressure. Remember, the previous week's financials started to show some signs of life, and we wanted to see that stick. But now as yields have begun to move lower, financials are beginning to underperform. Industrials were beginning to show some signs of life in that rotation into beaten down value areas, started to give some back, and discretionary was a weak group on the week, down 2.5% at the sector level over the past 5 days of trading. Turning now to our industry in focus, and the industry in focus is home builder services, and this is one that we've liked. If you've been reading our notes, if you've been following along, we've been highlighting the home builders as a leading industry group within the marketplace, right? Looking at whether it's looking at 12-month performance, whether it's looking at 6-month performance, it's been an outperformer. When you can see that here over the past 6 months, the home builder subsector has outperformed the S&P 500 by 6.39%. And the power bar ratio, which measures future potential, right? This is how we gauge whether or not outperformance is likely to continue. Power bar ratio, very strong. 15 bullish or very bullish stocks, only 3 bearish or very bearish stocks. And the group is currently ranked number 6 of 21 subsectors. Now, some of the indicative names there, all with very bullish shake and power gauge ratings, are names that we've talked about here and names that we've highlighted in our notes. Taylor Morrison, TMHC, MI Homes, MHO, and DR Horton, DHI, all with very bullish ratings indicating that they are likely to continue to outperform the market. Now, what I will say is I took a look at all 3 of these stocks to see if the setup looked compelling now, and they're overbought for the most part. Well, let's take a look at the fund, the XHB, the SPDR S&P Home Builder ETF. Stock has a very bullish shake and power gauge ETF rating, and the trend is strong as the fund is trading above a rising long-term trend line. Similar analysis, right? Been on that bullish or very bullish rating since April, and the stock has been outperforming the market pretty much since the beginning of the year. So the market and model are in agreement for the fund, rather. I always say stock, I mean fund in this case. Market and model are in agreement. Persistently bullish money flow above the rising long-term trend line, above key support levels. You have key support here around the $42 mark. We have a breakout, a throwback to retest that breakout level. As long as this fund holds above $42, I think it looks compelling, especially if the overbought, oversold indicator moves closer to an oversold condition. I think home builders continue to be an area of the market where we want to focus for bullish ideas, but we want those stocks when they become oversold. Taking a look at what's trending now, Friday's gainers and losers, our movers and shakers in the S&P 500. No real news to send INSEE higher by nearly 4%. Align signed a distribution agreement that sent that stock higher by 3.43%. Regeneron reported some positive phase 3 trial results. That was enough to send that stock higher by 3.4%. Dentsply, no real news there, stock higher. Did note, though, that healthcare was a leader on the day. Dentsply up 2.5%. And IT, the services group has been trading positive of late, and IT is a member of that software and services group. The services portion of that group was trading well towards the tail end of last week. IT added 2.43%. On the loser side of the board, Xilinx down 6.8% as the CFO steps down. Netflix, some cautious sell side comments sent that stock lower. No news on MSCI. FLR talking about cost cuts and dividend cuts to get their balance sheet in order, sent the stock lower. And ROST, no real news there. Let's take a look at those small caps now. Here's the IWM, the iShares Russell 2000 ETF, our proxy for small caps, and you can see that it is fading from resistance. Small caps fade from resistance. Now, holding above the 200-day moving average, RSI never became overbought on this spike, but it hasn't really become overbought since the beginning of the year. So continues to be middle of the road, confirming this price action that we're seeing. But the key here for investment strategy is the relative strength. And at the bottom of the chart, you can see a clear downtrend as the IWM is underperforming the S&P 500 over the past year. Now, we have seen a near-term spike. Remember a couple of weeks ago, we started to see some small cap outperformance that got people excited. But honestly, the bigger picture trend has not changed here. Now, resistance in this kind of, call it 158 to 160 zone, support 145 to 150, really just range bound trading for the most part. And until we see a decisive break above that 160 level, it's really hard for me to get excited about small caps, especially as they continue to underperform the market. 10-year yield resumes its downtrend. Right? Everybody was talking about that big spike the previous week, week and a half, and it was a big spike. There's no doubt about that. However, the yield has started to move lower again, back below the declining 50-day moving average. Never even came close to threatening the declining 200-day moving average. And what's interesting to me is despite this thrust higher, this big spike higher, RSI never became overbought. So momentum does remain bearish, confirming this trend. I think as long as the 10-year yield is below 2%, the path of least resistance remains lower for yields, which should continue to support the bond proxies in the equity market, right? This is why we pay attention to intermarket analysis. We pay attention to what's happening across asset classes because it has an impact on the equity market where we spend most of our time. So below 2%, I think you need to continue to favor the bond proxies in the equity market, which honestly started to play out last week. As you can see here, look at utilities going out at a new high. XLU, the utility select sector SPDR fund, closed at 63.87. Right, it's just running higher above the 200-day moving average, above the 50-day moving average. RSI continues to hold in bullish ranges. What's interesting to me is that XLU has a bullish Chaikin Power Gauge ETF rating, and look at the power bar ratio for XLU. 8 bullish or very bullish stocks, 0 bearish or very bearish stocks. So when we start to put the mosaic together and think about whether or not utilities continue to outperform, the odds favor yes, right? Falling yields, bullish power bar ratio, bullish power gauge ETF rating, holding in bullish ranges from a momentum standpoint and holding above support on a relative basis stands to reason that XLU will continue to outperform. So you want to look at a name like Duke Energy, DUK, which I'm highlighting in my note today. Bullish power gauge rating, strong trend, strong industry group. Market and model are in agreement here as that bullish rating is met with outperformance. Oversold stock with bullish money flow checks all 6 boxes on the checklist. Duke looks good to me, especially if it holds above the 92 mark. Odds are it will continue to move higher and outperform the market. That's going to wrap it up for today. Have a great Monday, everyone. I will be back here tomorrow.